Welcome everyone to Daily Mortgage Rates Live with the Mortgage Calculator. Appreciate everybody tuning in early. We're going to wait just a few here to let everybody jump on. In the meantime, feel free to comment there in the chat. Appreciate all the comments. I see there were already some people commenting there. Thank you for the comments, Dea, Michael, Julio, Warren. Appreciate it. We'll get started here in just a moment. Great topic here for today. We've touched on it a little bit in the past, but today we're going to do a deep dive here into the FHA 203K loans. So definitely excited for that. All right, Jason, Dario, Jake, appreciate you guys tuning in, dropping the comments there. And it looks like we are live on all the different platforms, so we can go ahead and get started here. Feel free to keep dropping comments and drop any questions you have there as we go through the presentation. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. What we do every morning on this show is go through some live mortgage rates of a few different programs. Then we do a deep dive into a different topic every day. And today's deep dive is going to be FHA 203K loans. So definitely a unique product. So our sales manager, Jose Gonzalez, with 28 years of experience as a loan officer and a realtor, is going to do the deep dive into FHA 203K loans here momentarily. But before we do that, we'll do what we do every morning, which is pull up our pricing tool and go through some live rates. So Nick, if you're ready, let's go ahead and pull up the pricing tool and see what the market is looking like this morning.
All right, let me switch my screen and we will check it out. So this is our pricing tool for our team of mortgage professionals. If you'd like a full breakdown, please get with one of our 400 loan officers. They can send you a full loan estimate with all of the fees broken down. But this will show us the general rates and the APR for today. It is Monday, September 18th. So I haven't even checked the rates this morning. They are live now, getting brand new rates here just after 11 a.m. Eastern. This will show us the APR with the fees, but if you'd like a full loan estimate, get with one of our team members. So to compare the different programs, we will set up the same scenario and compare the APR across the programs. We'll set up a $400,000 loan amount, set the LTV to 80% loan to value, 20% down payment. We'll set the desired price to 99. It means we're going to ask the computer to find the best rate at one discount point in cost. And we're going to check out our conforming conventional options. Then we'll check out FHA, not the 203K, just the regular FHA. And then we'll go into expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs with alternative income. We also have VA and USDA. VA is only for eligible service members and veterans. If you are eligible, let us know. You can quote it in just a couple clicks. And USDA is only for eligible properties. If you do happen to be shopping in one of those areas, let us know. It just takes a couple clicks for us here. Now we'll start with conforming conventional. We'll do a purchase, 30-year fixed loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated credit score of 760 and an estimated debt to income ratio here of 40%. So with the settings that we do every morning, let's check the rates today. I think it's about the same as it was last week. Not much change. 7.375 rate, 0.875 discount points of cost. Final APR 7.538 here. So if our customer doesn't qualify for a conventional program, usually this is the first option we look at. We usually want to compare a standard FHA option. So let's go back to our pricer here. We'll set up the same exact scenario. This time we'll select FHA, which does allow a little more leniency on credit issues, as well as a higher debt to income ratio. But we'll keep everything exactly the same so we can compare the APR here. And FHA, not much change either here. 6.5 rate, 1 discount point in cost, puts the final APR 7.092. So pretty significant savings here for someone that would qualify for both conventional and FHA. Almost a half a point today in difference between those two options. So definitely our customers that qualify for both, check the FHA out. And with the recent changes to the FHA-MI, this is actually a great deal as well for our customers that have to use the FHA programs. So definitely check those out. And Jose will present a couple pretty cool specialty options here as the deep dive, where we have our specialty FHA programs, such as the 203K. Now, if our customer doesn't qualify for FHA or conventional, many other banks or lenders have to deny that customer. But fortunately, here at the Mortgage Calculator, that's what we specialize in. So we'll set up the same scenario, but this time we will choose expanded guidelines, also known as non-QM. We have over 5,000 additional programs to qualify our customer. So we'll keep everything else exactly the same. However, we have a new option that pops up where we can use alternative income. So full docs, what we would have to use for conventional and FHA, that's 2 years tax returns, what most people are used to. So we'll typically choose a non-QM program to select a different option here, such as our asset related, business bank statement. Our investor programs are just for investment properties. Personal bank statement, 12-month is the most popular. We always use that for the demo. We have RSU stated, VOE, 1099, P&L, no income CDFI, all kinds of different options. But the most popular for a primary home be a 12-month personal bank statement program for our self-employed borrowers. Many times it's our self-employed borrowers, when they submit 2 years of tax returns, have different write-offs and may not qualify at all, or just may not quite get enough income to qualify for the home they really want. So we'll solve that problem here for our borrowers by using no tax returns at all, just their last 12 months of bank statements, to determine a debt-to-income ratio of 40% in this example, using just their cash in the bank, no tax return at all. So most of our self-employed borrowers will qualify for double or triple the income using this method and can therefore qualify. So let's check out our non-QM solutions today. And not much change here either. 7.5 rate, 0.2 or 2.875 discount points in cost, so always a little bit higher cost here for non-QM options. But our APR 7.629, almost identical to conventional. Remember, conventional was 7.5 and change. Here we have an option at 7.629. Some of these other options, maybe slightly different programs, slightly higher rates and costs. They're all around the same, but some of these may allow other issues such as foreclosures or bankruptcy. So you see we have hundreds of different versions of these programs that would allow us to qualify our customer when they would otherwise not qualify. So please get with our team. They'll find which one of these hundreds of options works best for you. And before we pass it over to Jose, we always want to do our investment property live rates. So we'll do a couple demos here for investors. Whether you're a first-time investor or seasoned investor, we have some cool options. So we'll set up the same scenario, 80 LTV, 20% down payment. And we're going to compare our two options here, conforming conventional, and then we'll check out our most popular expanded guideline non-QM option. Remember, government programs, FHA, VA, USDA, they do not work for investment properties. So we'll start with conforming conventional. Everything else is going to stay the same as all our demos. The only thing we've edited here is occupancy. So let's see what adjustments conventional has added for investment properties. Best option here at the top, 7.625 rate, 3 discount points in cost, puts our final APR at 7.858. So unfortunately with conventional, even though the rates are a little higher, thankfully they've raised the rates we can go to so we can get cheaper discount points. But the computer can't find any rates at 1 discount point in cost. So typically our investors ask for other options because 3 discount points is quite a bit of money, $12,000 in this example, the cheapest example. And that's money that our investors would rather spend elsewhere typically. So we typically solve that problem by choosing a non-QM program. So for the final demo, we'll do investment property, set up the same scenario again. And this time we'll choose expanded guidelines, also known as non-QM. And for investment properties, the most popular option is the investor DSCR. That's because it doesn't require any income or employment from our borrower. We're simply going to use the estimated rental income from the property to determine a DSCR value. It stands for debt service coverage ratio. If the estimated rents can cover the mortgage expenses, the PITIA of the mortgage, that's a ratio of 1.0 or higher, aka the property cash flows monthly. Even if the property does not cash flow monthly, that's a ratio under 1, and we have options for that. For the demo, though, we always put 1.5, which is the highest, so we can see all the different options pop up. And a prepayment penalty is standard on a non-QM investment property program, so we always choose 3 years so we can show the most common programs. We can select 0. That will limit the loan programs that show up and cost more. We can also select 5 if we wish, which will, again, limit the loan programs, but save our customer some money for those programs that do allow it. 3 years is the most common, so that's what we always select, so we can see the most options pop up here. So let's check out the DSCR options. All right, best option at the top, 7.99 rate for 0.85 discount points and costs. That's our final APR at 8.052. So just a touch higher on the APR, but we've saved our borrower here the discount points from 3 discount points to 0.85. That's almost $10,000 that the borrower can spend elsewhere, and the DSCR loans are much easier. So I'd say 90+% of investors, when comparing a DSCR loan to a conventional loan, especially when they're almost identical in cost here on the APR, will choose a DSCR program. So definitely recommend all of our investors check those out. And as you can see here, we have tons of different options. Some of these may allow bankruptcies and foreclosures like the other options. Some of these may allow short-term rental income, very popular request for our Airbnb crowd out there. So tons of different options. Please get with our team to find the best one. All right, now let me switch my screen again. And we'll get into today's topic. So today we'll be going into a specific type of 203K loan. So we don't have any specialty loans on the automated pricing system there. So Jose has gone through and priced a few examples for an FHA 203K loan. Definitely popular request. Jose always recommends it as inventory is getting tighter. Definitely can open up your borrower's search criteria, right? Now, instead of just finding the property they want, they can find just the property in the location they want. Condition has no meaning, right? The 203K loan allows us to repair whatever needs to be repaired to not only bring it up to FHA standards, but also put our borrowers' personal touches, right? If you need a kitchen, you can choose your kitchen, right? So we can obviously more focus on area and final project, right? Final location. What do they want in the end? What is their forever home, right? Where do they want to live forever? Rather than what is the closest to their criteria and basically settle, right? So I love the 203K because it allows our borrowers not only to open their criteria, but instead of settling for what's there, now they can create what's really in their mind's eye. So definitely cool programs to have. Definitely pretty easy to qualify since FHA does allow a little more leniency than some of the other programs. So this is probably the easiest one to qualify income-wise. But as Jose will probably explain, it's definitely very strict on a lot of the standards as well. So make sure as loan officers, we understand all of the ins and outs of this program. But it's very cool. Me and Kyle have also taken advantage of some of these ourselves. So they're very cool programs when they do work. So Jose, if you're ready there, let's go have you introduce these examples.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. So I will jump right into it. Definitely, this is the product to use to combat inventory shortages, as Nick was mentioning, especially for borrowers looking to purchase with FHA financing, which in some markets that are extremely tight in inventory, they do tend to give preference to a conventionally financed loan over an FHA finance loan, whether it's preconceived notions or what it may be, but that is what happens in some of the busier markets. So we do have our FHA borrowers sometimes struggling beyond the usual struggles right now with limited inventory to get their offers accepted. Usually, this could be resolved by a number of things. You could increase your footprint of available inventory. For example, if you are looking at the scenario from a purchase point of view as opposed to a refinance point of view, by having a larger pool of available properties to be able to select from. Normally, we would have to select from the pool of available properties with no condition related items like vandalism, for example, or foreclosed properties, which could be missing components like the kitchen cabinets, bathrooms could be, deconstructed. You could have missing AC units, hanging electrical wires, all sorts of things that happens to properties when they're foreclosed. So with the 203K, you do have the opportunity to purchase those properties almost as if you were a cash buyer, because the condition related items can be remedied with the renovation portion of the loan. However, I will note that the 203K loans do require some logistics from the borrower, as far as contractor, right? Because you're purchasing a property. It's a little bit easier when it's a refinance of your own property, right? But if you're purchasing a property, just came into it, there's limited amount of time for you to really be able to vet the property. But you should make sure at least that you have a contractor already locked and loaded, so to speak, ready to jump on whatever requests you may ask regarding estimates and the completion of the forms. Because with the 203K loan, not only does the borrower need to be credit and income approved, uh, not only does the property need to be approved as far as the renovation expense, the as is value, and then the ARV, the after repaired value, because that's really what will be the limiting factor to your loan amount, right? You can say you want to do as much as you want, but if the after repaired value does not support all the renovations you want to do, some of those are going to have to be paid out of pocket in the form of additional down payment, because you're going to be limited at 96.5% of the after repaired value as your maximum loan amount. Something else to consider now, besides obviously having your contractor ready, who is ready, willing, and able to complete all those forms in a detailed manner. Can't just have that estimate written on a napkin, right? But the other factor, besides the ARV, is the HUD, the use of a HUD consultant or not. The streamlined option limits the repairs, the possible renovation, to 35,000. And the benefit of the streamline option is that a HUD consultant is not required. Why could that be a positive thing? Well, because the HUD consultant is going to go to the property on a regular standard 203K option, review the scope of the work, and see if there's anything else needed to meet HUD's property condition guidelines. FHA is very strict about the livability of a property, so they're going to look at it on these loans like they do in every other FHA loan, right? So stuff like peeling paint, the types of locks you have on a home, and just other factors that could render the home, in their opinion, not livable. And then if you have not addressed these items in the scope of your work, they're going to include it, and that's going to increase your budget, right? So that obviously could have an effect if you are already at the limit of your ARV or of your qualification via DTI, and there's no additional room to increase the loan. You're now going to have to uh, revise the scope of your work and possibly not be able to do some of the optional renovations that you wanted to do, because now you have required items per the HUD consultant.
Change some of your wants
Yeah.
for needs, right?
Yes.
So when there's a need, you have to change some of your wants out, right?
Absolutely, which would be terrible, if you have everything planned out. Now all of a sudden, they uncover who knows what it could be, right? But it could be as simple as rotted wood fascia to as complicated as maybe they require you to do a mold inspection, and now you have thousands of dollars of mold remediation to do to a property. That could really put a damper on your renovation. So keep in mind, the difference between the streamline option for your maximum $35,000 of renovation, because that is the maximum under the streamline option, or the regular standard option. If you need to do any structural related items too, you would have to go to the standard option. So let me share some rate quotes. Here, our first option is for an FHA 203K 1 unit purchase at a 96.5% LTV, 3.5% down payment. So this is pretty good rates here. We have 7.625 is at par, and you can buy that down all the way to 6.49%. And our next option is a standard as opposed to the streamline. And luckily, the rates are the same for this standard option versus a streamline option. 7.625 at par, 6.49 is the lowest buy down rate. So I have a couple of refinance options here now. Keep in mind, in the 203K, you cannot have any cash out. I mean, you're already theoretically getting some cash out to do the repairs. That's part of the program, but you cannot get any additional cash out.
Meaning, if you go under budget, it just goes back to the loan.
Correct. They just
so you don't have to be exact, but it just goes back to the loan. Right.
Yeah, they're just going to use it to reduce the principal balance. That's it. So here, pretty good rates as well. 7.75 is par, 6.5% is your lowest buy down, and this is for a streamlined 203K option at an 80% LTV. And our last example here is our standard 203K, and this one again does have a little bit lower rate, just like we saw in the purchases, of 7.625 at par, and you can buy it down all the way to 6.49%. So very good options. 203K, definitely recommend everyone to look into it, but I do recommend, again, if you are consulting some borrowers about it, explain to them the importance of looking for that contractor as soon as possible who will be willing to come on board to the 203K process, right? You have to let them know what it is, because there is some tedious paperwork that needs to be completed for that process.
All right.
All right, we got one question on the actual 203K, so let's do that first, and then we got a general question here. So how can an extensive repair such as a crack slab be done with this loan? I mean, any repair technically. So the requirement of FHA is that it has to be a home that's now being built into a new home, and you can't really expand that home, right? So you could have a burned down house, completely burned, and just a foundation. As long as you use that foundation, even if the foundation is cracked, right, you could fix the foundation and then build up from there. So there's really no technical limits, correct, Jose, on
Correct.
The scope, as long as it works, right? If it's going to cost $1 million to repair, but the after repair value is only $500,000, no loan is going to work on that home, unfortunately.
And if it is a structural repair in nature, like I would believe a cracked slab would be, it would have to be the standard 203K option instead of the streamlined 203K option.
All right, looks like we got a general question that was asked when you were going through the DSCR loans, Nick, which is how much is the typical prepayment penalty on a 3-year?
That's a good question. It varies on the program. So every program has different. So you saw there was a big list of programs. Some of those, the differences there, there were little notes there of different PPP amounts. So some were fixed PPP. The more typical is a declining prepayment that's going to be based on 6 months of interest payments is the most common. However, there are 5, 4, 3, 2, 1. There's for a 3 year, it'd be 3, 2, 1. There's all kinds of different ways to do it. So just depends on the program, which way you go. If you have like a foreclosure or bankruptcy and you're going towards the set of programs that work for foreclosure or bankruptcy, they might have a certain prepayment penalty they require for those subsets of programs. So it all depends.
All right, and another question came in here, which is, can we do 203K loan on mixed use properties?
Mixed use now, yes, but you got to understand what FHA considers a mixed use property, right? Mixed use property would be owner occupied mixed use, where you are occupying part of the property. If properly zoned and everything, you're occupying part of the property for your business somehow, right? Maybe you're just doing a home-based business, or maybe it's actually some type of a retail component or something like that. But there are pretty strict requirements that FHA has for mixed use. So if your property meets all of the mixed use requirements for FHA, then it would just be a standard FHA 203K loan, whether you're going standard or streamlined, right? But the first thing to note is, does that mixed use property meet the FHA mixed use property guidelines?
Just because it says it's possible doesn't mean it's feasible, right? Possible and feasible are definitely two different things. People, I think, get a little excited when they see that there is a box of mixed use, but very seldom do we get to use that exception.
All right. Well, thank you for the questions. That was great. If you want more info on these programs, visit themortgagecalculator.com. We can pair you up with one of our team members. Remember, we do this show 11 a.m. Eastern every single weekday, where we go through the live rates and do a deep dive into a different topic every day. So we appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. And we'll see you all tomorrow with a new topic at 11 a.m. Eastern time for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.